When interest rates change, they have a ripple effect across the entire economy, and one area where they are felt almost immediately is in the housing and mortgage market. Refinancing, which is often seen as a tool for saving money or restructuring debt, can look very different depending on whether rates are going up or going down. Today we're going to break down how rising interest rates affect refinancing, why it matters for homeowners, and what options people may still have even when borrowing costs are climbing. Let's start with the basics. Refinancing a mortgage means replacing your existing loan with a new one, typically with better terms. For most people, the main goal is to secure a lower interest rate, which leads to smaller monthly payments and less total interest paid over the life of the loan. However, when interest rates start to rise, that benefit can disappear quickly, and in some cases, refinancing can actually cost more instead of saving you money. So how exactly do higher interest rates impact refinancing? The first and most obvious way is through higher monthly payments on new loans. If you refinance when rates are higher than your current mortgage, you could end up locking yourself into a more expensive loan. Imagine having a mortgage at 4% and then considering refinancing when the average rate is 6%. Your new loan payment will almost certainly be higher, and the long-term interest costs will add up to thousands of dollars more. That's why rising rates tend to discourage homeowners from refinancing for the sole purpose of lowering their payments. The second effect is the reduced incentive to refinance. Refinancing makes the most sense when you're able to cut your interest rate by a meaningful amount, usually 1 percentage point or more. But when interest rates rise, fewer homeowners meet that threshold. As a result, the overall number of refinancing applications drops across the mortgage industry. For example, whenever the Federal Reserve has raised rates in recent years, refinancing activity has fallen sharply within months. It's simply less attractive when borrowers realize their current mortgage rate is already lower than what the market is offering. That doesn't mean all refinancing stops, though. Some homeowners still choose to refinance even when rates are higher, but their reasons change. One of the most common alternatives is cash-out refinancing. With a cash-out refinance, a homeowner replaces their current loan with a new, larger one and takes the difference in cash. This can be used to pay for renovations, consolidate debt, or cover major expenses. Rising interest rates make this option more expensive because the new loan carries a higher cost. But for homeowners who need access to equity, it can still be worthwhile. Another area where higher interest rates come into play is loan qualification. Lenders look at something called the debt-to-income ratio, which measures how much of your monthly income goes toward paying debts. When interest rates rise, the projected monthly payments on a refinanced loan also rise. That means some borrowers who may have qualified before no longer meet the requirements. For example, someone who could comfortably afford a refinanced loan at 4% might not qualify when the same loan payment jumps by several $100s at 6%. Rising rates tighten lending standards indirectly, simply because the numbers no longer fit within the required limits. For homeowners with adjustable-rate mortgages, known as ARMs, rising interest rates create a sense of urgency. Adjustable-rate mortgages start with a lower fixed rate for a set period of time, then adjust based on market conditions. If overall interest rates are climbing, homeowners with ARMs may want to refinance into a fixed-rate mortgage before their rates reset even higher. The problem is that as rates rise, that window of opportunity gets smaller. The longer someone waits, the higher their future fixed rate may be. So, while refinancing to save money becomes less common, refinancing to avoid risk becomes more important for people with adjustable loans. Now let's talk about the broader trend. Historically, refinancing activity tends to rise and fall in direct relation to interest rate movements. When rates fall, refinancing applications surge because millions of homeowners see an opportunity to lower their monthly bills. When rates climb, refinancing drops, sometimes dramatically, because the pool of eligible borrowers shrinks. For example, during periods of rapid rate hikes, the refinancing market has contracted by more than half in just a few months. This shows just how sensitive refinancing is to even small changes in interest rates. It's also worth noting that higher interest rates can affect homeowners psychologically. Even if someone could benefit from refinancing by accessing equity or consolidating debt, they may hesitate simply because the new rate feels too high compared to what they have. This hesitation often leads to delayed financial decisions, even in cases where refinancing could still be beneficial for reasons other than lowering payments. So what can homeowners do in a rising rate environment? The first step is to carefully evaluate their current mortgage terms compared to what's available. If your rate is lower than the market average, it usually makes sense to stay put unless you have a pressing need for cash or want to switch from an adjustable to a fixed-rate loan. If you are considering refinancing, it's essential to calculate not just the monthly payment, but also the total interest cost over the life of the loan. Another option is to look beyond traditional refinancing. For example, instead of refinancing into a new 30-year mortgage, some homeowners consider shorter loan terms, like a 15-year mortgage. Even though the monthly payment may be higher, the shorter term reduces the total interest paid, which can offset the effect of a higher rate. Similarly, some borrowers explore alternatives like home equity loans or lines of credit, which may provide the funds they need without replacing their entire mortgage. At the same time, rising interest rates serve as a reminder that timing matters. Refinancing is not just about whether rates are high or low today, but also about where they might go in the future. If you believe rates will continue rising, locking in a fixed rate now may still make sense, even if it's higher than what you have. On the other hand, if there's a chance rates could stabilize or drop, waiting might provide better opportunities. In conclusion, rising interest rates affect refinancing in several important ways. They make new loans more expensive, reduce the incentive to refinance for lower payments, and can make it harder to qualify under lender rules. They shift the focus toward cash-out refinancing or converting adjustable-rate loans into fixed ones. And they cause overall refinancing activity to decline across the market. While higher rates limit the potential savings, refinancing can still serve specific purposes depending on each homeowner's financial goals. The key takeaway is that refinancing is not a one-size-fits-all decision. In a rising rate environment, homeowners need to think carefully about their goals, weigh the costs and benefits, and run the numbers before making a choice. Sometimes the best move is to hold on to the loan you have, while other times, refinancing can still provide value even if rates are higher. Understanding how interest rates affect refinancing is the first step toward making an informed and confident decision.